Well, now to help us focus on the fundamentals behind the technicals, I've got Luke Gromen, founder, president of FFTT LLC, with us this morning. Luke, good to have you on this Wednesday morning. Let's talk about the 2-year inching its way back up to 5% ahead of the inflation data due out today. The Fed meeting next week. What's it telling us?
I think people are starting to get concerned that inflation is about to begin reaccelerating, and I think it's a valid fear.
And do you think we'll start to see the longer dated then participate? Do we expect a breakout at this point? Or can we keep what we're seeing in terms of some of the price activity relatively contained? I was just looking at the futures, and we've got the treasuries rolling over here now and inching their way back down towards these lows that we saw last month.
I do think the long end, I actually think the long end is going to break out to new cycle highs. I think there's an important dynamic going on as it relates to the long end in particular that we last saw in the second and third quarters of last year, which is the terms of trade for the United States' foreign creditors, energy importing foreign creditors in particular, is deteriorating rapidly. So the dollar has bounced. That puts pressure on dollar-denominated debt, forces U.S. foreign creditor selling of treasuries. Oil has bounced sharply. And this is also putting pressure on the terms of trade for U.S. foreign creditors. What do they sell to raise dollars to buy energy as the price of energy rises? They sell treasuries. So we get into, we are very close, in my view, to getting into sort of the vortex that we got last year. Dollar up, oil up, rates up, stocks down, dollar up, rates up, stocks down, dollar up, rates up, stocks down.
It all sounds very bearish.
Yeah, in the short run, it is very bearish. And so what needs to happen to stop this? You got to get the dollar down, and you got to get oil down. And if you look back to last year, we released the SPR. We raised rates aggressively, and that worked. Now, the SPR is lowest level since 1985. Who knows what's left in there? Who knows what quality it is? At some point, that thing getting low enough will drive oil higher because people will start to question how much is left, how much more they can do. And on the dollar, you know, we saw last fall Yellen come in, run down the TGA aggressively, basically more than offset Fed QT in the fourth quarter. The dollar fell almost 15% from the fourth quarter and into the early part of 1Q23. That's the type of thing that needs to happen soon if they want to avoid this dynamic. Now, the problem, of course, is there's an order of operations. You run the dollar down 15% with oil at 90, oil's going to be at 110, 120, and you might make the problem worse. So
without some sort of a supply disruption. I mean, add a supply disruption into that, you're talking oil back to 130.
Absolutely, absolutely. And so they're in a bit of a tricky spot. So the long and short of it is I think long rates are very likely going to break out and go higher.
Talk to us a little bit about how the indices, for the most part, I mentioned all of these scenarios that you painted out there being very bearish. I meant for stocks, and for the most part, we've shrugged it off. I've got a great chart here showing how well 10-year yields, as we just pointed to, they're taking out the fall highs from last year, but basically stocks are nowhere near those lows that we saw last fall. S&P is down around 3,500, 36. Here we can see around 4,500 right now. Is this a levitation act, as I've been kind of seeing it as in many ways, but it's been resilient, and so that kind of pushes back on that idea? Or is this just investors and traders coming to grips and being somewhat callous with this higher rate environment and expectations for recession being pushed back and a really strong economy here in the U.S.? How have indices shrugged off this move higher in rates?
I think it's a little bit of all of that. I think it's important, too, to note that as time goes on and as it becomes more obvious that the United States is in fiscal dominance, in other words, the Fed's not driving the boat anymore, the White House is. And partly what the Fed is doing to try to slow inflation is making it worse just on a lag, right? Because let's take a step back. Fed raises rates to 33 trillion in debt. That's on a pro forma basis. That's $1.65 trillion in interest expense. $1.65 trillion in interest is like 6-7% of U.S. GDP. That's just a stimmy. It's just handed to wealthy asset owners instead of to everybody like it was in COVID, in smaller amounts, by the way. And then when you overlay what the Fed's doing in terms of tightening private capacity, we know what happens to inflation when you constrict supply chains, constrict capacity, and send out stimmies. Inflation goes up on a leg. All the Fed's doing is creating an interest payment stimmy by raising rates, handing it to wealthy asset owners and boomers who are holding it for a bit, and then they're going to go and spend it. And into an economy where Fed rate hikes are curtailing the private sector. And so I think that's what markets are starting to see, which is, yes, the rate hikes are biting into the private side. A lot of the private indicators we've all watched for the last 30 years in our careers are looking pretty recessionary. However, none of us have ever been alive when the Fed has raised rates to 5% with the deficit at 6-7% of GDP, with debt at 120% of GDP. The number one impulse of the economy is now the U.S. government. They're out. It's 25-30% of the economy, and it's growing 15-16%, helped by the Fed raising rates. So I think people are starting to go, wait a second. If we're really in fiscal dominance, I don't want to own bonds. Certainly not at the long end. I'd rather own, if I've got to be somewhere, then I'm better off owning stocks. And you can see the ratio of the S&P to the TLT, to the long bond, has exploded higher over the last year.
Is that what we saw in the auction yesterday? It seemed to go pretty well. And we've got more issuance here headed our way later this week, it looked like. But there's been some focus on that as well. And I asked because the last time around, it seemed like with the massive issuance, we saw quite the run up in yields, treasuries coming off, the futures coming off. And so I kind of wonder if this is more tied to expectations associated with the Fed, CPI, and your point about inflation being a bit more entrenched, or is this just kind of tied to what we're seeing in terms of this massive issuance, which continues to play out?
Yeah, I think it's more the former. I think it's more just a growing realization that inflation is going to be stickier, and yeah, exactly.
Talk to us a little bit about some of the currencies to keep an eye on into the end of this week and next week, for that matter. You've got, well, front and center, first and foremost, the ECB ahead of their decision. There's some debate in terms of whether we're going to see a hike tomorrow. Some of the data has been, again, kind of suggesting that the economy remains under pressure here still, but inflation still an issue to be dealt with.
Yeah, they're sort of a dumpster fire on the opposite side of the situation with the U.S., right? So the Fed needs to cut and weaken the dollar with oil at 90 to try to keep things okay. The ECB needs to tighten with industrial production absolutely imploding. So I think it's going to be a very interesting week. I think ultimately, I don't think the Fed and U.S. authorities are fully prepared to do what they need to do yet. So I would be long the dollar over the next week. If weekly trading is not really what we do, but if gun to my head, I'd be long the dollar against the euro over the next week and a half, because I think the ECB's credibility is failing rapidly, and I think the Fed I don't think fully grasps exactly what they need to do yet in terms of weakening the dollar despite where oil is. So that's all I'm thinking about at the moment.
Luke, I'm looking at the number here. You just mentioned industrial production month over month down 1.1% in the EU. That was out this morning here, year over year down 2.2%. I also noticed the UK, speaking of being in between a rock and a hard place, their GDP contracted 0.5% a month over month basis. That's ahead of the Bank of England next week. And we've been seeing some of these foreign currencies which have been weakening, that also bolstering the U.S. dollar as well.
That's exactly right. To me, the pound, if nothing changes, I think over the next 6 to 12 months, there's going to be a reappraisal of what the pound is from sort of, SDR currency to SDR currency that's actually with a lot of emerging market characteristics. So that's one I think could get a lot weaker over the next 6 to 12 months.
Luke, lastly, before we let you get out of here, I noticed on your Twitter handle you were asking for some questions. You were going to do a podcast. I didn't see the actual podcast or get a chance to listen to it, but a sneak preview possibly here on the show, or what stood out in terms of questions? What were most of your followers asking about?
Sure. Really, in terms of the near term, the implications of the Bank of Japan possibly, jawboning, but possibly shifting from exactly, and sort of what the implication. And the short version of it is all else equal, that raises global capital costs. That's the Japanese repatriating foreign capital back to Japan, and that ties back to that point we were just discussing about the long end of the U.S. So if Japan's doing that, that's upward pressure on U.S. rates across the curve and at the long end overall. So that was I think a real a point of interest over the weekend.
Well, in this instance, maybe not necessarily a case where the trend is your friend, but definitely a case where, as I like to say, continuation more likely than change. It seems to be not only here in the U.S. in terms of rates to the upside, but globally, quite the narrative here. And Luke, appreciate you joining us to help us break it down and talk financial markets here ahead of the closely watched CPI data, which is coming our way in just about 2.5 minutes, as well as ahead of that Fed announcement next week. Luke Gromen, founder, president of FFTT LLC.